Hey everyone, it's Imran from Options Insight back with another macro options spotlight. Okay, stocks rallied to close out the quarter. PCE came in slightly light, and then month-end rebalancing flows came in. We had a strong day, up about 1.5% to 2% across the US indices. Europe and China did lag a little bit. We also got a disappointing China manufacturing PMI overnight, so a little bit of a pause there. Energy did lead commodity space. We had nat gas rally on Friday, oil rally as well. Oil was actually up 9% on the week, and then over the weekend we've had OPEC Plus unexpectedly cut production. So a bit of front running there has worked out for the buyers, and metals drifted lower, consolidating recent gains. Looking at vols, they were down as markets rallied, but some support coming back for fixed strike vol. So, when you get a strong move like 1.5%, you would expect at the money vol to trade lower. It was only lower by half a vol. That actually equates to some buying coming back in the options complex. And then we did see a fairly sizable vol drop, 3.5 vols on the week, an S&P there heading into Easter. So a bit of Easter quietness getting priced in ahead of time. So you often see the vol kind of overshoot a little bit early, and then it bounces actually as you get closer to the quiet period. We've got ISM numbers in the US. We've got non-farm payrolls as well this week. So we do think vol may find some support, having overshot now to the downside. And then commodity vols were also slaughtered last week as well, from those higher vol levels that you generally get in commodities, and they were down pretty heavy. If we look at carry, negative carry across equities, except for NASDAQ slight positive. But generally that's because we had quite a violent rally. Implied vols got hit, but realized vols have kind of held up on the bounce. Now from here forward, we think even if we rally from here, the velocity of the rally probably won't be so violent, and so realized vol may come back down again. Okay, so some of these negative numbers will flip to green as the next sort of week or so goes on, we suspect. Looking at commodities, gold's the only one in negative. That's still moving around relative to its vol. On a 16-odd vol, that's a 1% break even a day. So gold's managing to do better than that. And then every other commodity is in positive, with your best earners being silver and copper for those who are brave enough to sell some vol out there. Looking at equity skew, we did see skew drifting lower, except for Russell, which was slightly higher on Friday. But in general, on the week, skewed down uniformly about 2 vols on the 1 month 25 data risky. And then looking at skew in commodities, really the big moves were in oil and uranium skew that was down about 2 to 3 vols a piece. But all the other skews relatively unchanged, nothing too exciting there. Okay, now the big news over the weekend is that oil spiked on this surprise production cut from OPEC. That was 1 million barrels per day, or over 1 million barrels per day, spearheaded by Saudi Arabia, who are going to implement a voluntary cut of 500,000 barrels per day from starting in May until the end of the year. Now, the supply cut is kind of being done ahead of any demand weakness from the banking crisis and a potential looming global recession. Rumors have it that Riyadh was not happy around the Biden administration ruling out replenishing their SPR reserves that they've obviously been drawing down for a while now, over a year or so, at these lower prices. They're saying they're not going to do it, or they're not in a rush, and it may take years. So that's been met with a bit of a unhappiness out of Saudi Arabia, and they've also been increasing diplomatic ties with China and Iran. So just fueling a bit more tension there against the Biden administration. Now, the market's reaction has been a 5% spike in WTI and Brent as short covering has kicked in over the weekend on that news. Managed money shorts had reduced. You can see this drop here in the short contracts. But there is room to go, right? It's still a relatively elevated number of shorts there. And longs are actually very depressed as well. So you might see fresh longs coming in, emboldened by OPEC's move to redeploy risk. And the fundamentals for oil, we know, look good, generally quite good, right? Especially if the China reopening does come in and we get some demand uptick. We don't think prices are going to run away to the upside too fast, though, in the near term, as China and India can still get discounted barrels from Russia. And there have been stockpiling ahead of the reopening already. So the trade that we pitched a few weeks ago was a USO call condor. That's actually done pretty well, and we've gone into the sweet spot literally on this latest uptick here at 5% move. So that's going to be earning its carry, doing pretty well, and we're probably going to sit on that position into the Easter break and see if that can continue to make us a little bit. Okay, looking at elsewhere, so HYG. So the high yield ETF we had a position on this a few weeks back. We were long puts to June as everything was unraveling and the banking crisis was kicking in. We were relatively underwhelmed by the performance of those puts, even though implied vols did spike in HYG. Just the velocity to the downside wasn't really what I would have expected if a recession was starting to get priced in. This was partly because of dramatic repricing in rates, slowing down the move because bonds were rallying, but credit spreads were rallying as well. So HYG came off, but not as violently as I would have thought. We did unwind our puts, though, in good time. And since then, we've had a pretty violent bounce back up to here, 75.5 on this HYG ETF. It does happen to be, the 61.8 retracement of the whole sell-off from sort of late Jan. So we think it's an opportune moment to maybe enter back into long put positions. Just because in general, we don't think these credit concerns are going away longer term. All the stuff that's going on in the commercial real estate market and general bank lending is going to be a problem going forward, we think, because of the deposit flight. So in general, we think credit markets are going to struggle. We've also got earnings season coming up. So some of these banks are going to kind of have to show us what skeletons they might have in their closet. And then markets might then have another bout of selling, particularly in the banking sector. So I think this is going to filter through to general sentiment across credit. So I like the idea of maybe redeploying some capital back into puts now that we managed to save a bit of money by getting out of those near the lows. Looking at our dashboard, we're kind of in between buying puts and buying bearish risk reversals here, because whilst the vol has come down, it is still at 10. And, this stuff can go as low as 8. So it could potentially go down still. Skew has also come down a bit. It's at 4 vols here. It did spike, closer to 5. It's chopping around. But in general, if we just look at it from a pure premium perspective, spot has rallied so much. It's really the spot rally that is producing the opportunity to fade this thing. And so, we think the vol's cheap enough to maybe own some puts here. Which puts would we own? Okay, that's it for today. Thanks a lot for listening. I'll catch you all tomorrow.